Well, good morning. Oh my gosh, what, Megan, was that rain last night? Intense and insane. I
So
heard it. Did you even hear it?
no, I didn't hear it. I actually slept through the entire thing, but I went downstairs to check on all of my water features and I definitely overflowed again last night. And so we've got some cleanup to do in my house. And I just keep blowing all the dead leaves off of my patio and my driveway. And I'm ready for the rain to stop.
It's a lot. It's a lot. We live in Denver for a reason, for the days of sunshine and not for the Seattle weather. And so we've got this going on. Although I have a creek at the bottom of my property and it is overflowing and gorgeous right now. So personally, I take last night for what I'm seeing this morning. But so I had the pleasure of doing a CEO leadership call yesterday, and that's where my quote this morning came from. And you and I talked about the quote and the gentleman that spoke. The gentleman that spoke was the founder and CEO of UGG. And it was really phenomenal. I'd never heard his story, but he's quite interesting. He's Australian in his late 70s and just going crazy in speaking engagements. And he wrote a book and the whole thing. But he's a very unique individual, very Australian. And so he brings over the UGG boots and he starts this company and they're just churning and churning and churning. And they're trying to get into different markets. They primarily broke into the surfer market. But the quote came from him. He had this written up on his wall and he said, "It's simple. Get out in front first and run faster. That's how you win." Right? Get out in front first and run faster. And I kind of put a big smile on my face, especially if you hear that in an Australian accent. I can't do it justice. But when you hear that, it's as simple as, what are you doing right now for top of funnel? How are you building your pipeline when the market is slower? We know interest rates are higher. We know a massive amount of demand is sitting on the sidelines. We know home prices are impacting affordability. So what are you doing today, working on your business instead of in it, to create top of funnel? And I wanted to start this before Megan gets into the data and really highlight the strategy opportunities that Megan and I love sharing. I know that she goes into a lot of teams and a lot of offices talking not just the data, but how do you strategically place your listings, work with buyers, and support your business given the data? And I do the same thing. I'm probably sitting down with 2 to 3 agents a day right now talking about how do we increase top of funnel with marketing, branding, video, messaging, all the things in content development. So if you need strategy, you want to increase top of funnel, I'd say go beyond the data, go beyond this 1-hour webinar and give us a call. We would love to support you growing your business so that we can all work together to help your clients to the finish line.
Yes, of course. We would love to help you guys out. It's all about strategy right now and positioning within the marketplace. And we're headed into another market shift as we get closer to the 4th of July. You've heard me talk about this before over and over and over again. And I'm just going to hop in and get right to the slide that I want to share with you guys so that you guys can see what I'm talking about, because we go through this market shift every year and I could nearly set my watch to it as we go into July 4th weekend. But as we head into July 4th weekend, early July versus late July, and listing in early July versus late July, you can see that our sales really start to cool down and our market really shifts. I end up getting a lot of phone calls directly following 4th of July weekend where people say, "Megan, I listed a property and I didn't get any showings on my property that first weekend," or "Megan, I did an open house and nobody came through." And what ends up happening at this time of the year is our inventory is continuing to build as we get into early July, late July, August, and September. And we start to see our active inventory rise, but our buyer demand starts to peter out. And so it creates this mini shift in the relationship between supply and demand, where our prices seasonally reset. But we've passed our big, heavy months of the year, and it looks like we peaked out March, April, and May of this year, and our buyer pool is starting to taper out right now. If people were going to make a move during the summer, they're probably already under contract, and the people that are moving right now are the people that have to move and not necessarily those that want to move. And so we're looking at a lot of people making life transitions right now in their home because they're having a birth, a death, a divorce, or loss of a job right now. And so those are the people that we really need to key into, that really need our help and support in the industry right now in order to make these life-changing circumstance decisions in order to move their property right now. And so again, looking at those months, we've passed the peak of our property market, and it's time to start pulling back in your pricing strategy. So if you're looking at comps that closed back in May, you're probably pulling back 1 to 2% in your original asking price right now in order to get that property under contract quickly this year. We're also starting to see increased price decreases. We're starting to see them become larger. We're also starting to see longer days on market as we tend to stretch into our summer months right now. Looking at where we are for our strategy sheets week over week, again, we peaked out in our odds of selling back here the week directly following Easter weekend, where we were at a 66.8% odds of selling. Now we're down to about a 58.3% odds of selling. So we've lost nearly 8 percentage points in terms of the odds of selling overall. You can see that our active inventory, this blue cell right here, is starting to climb. And as again, our active inventory tends to continue to climb until about September. At the point that we reach Labor Day weekend and kids head back to school, we start to see a lot of those listings withdraw or expire that didn't sell over the summer months in favor of waiting until next spring to sell their properties. This last week, we saw another 4.8% gain in our average daily active count. Our average daily active count is going up anywhere between 3 to 5% in terms of new active listing inventory. And it's not because new listings are coming on board. We ended up seeing that our new listing count went down 9.7% week over week, with only 1,177 new listings entering the market this week. That's down 26.7% from last year. It's because our inventory is starting to age and properties are spending longer on the market right now. Coming soons, we're down by 7.2% week over week, with only 220 total units coming soon. Back on markets are also down by about 10.1%. We're seeing less fallout right now in terms of our contracts. So things that are going under contract are stickier right now. They're actually staying under contract and going back on, or not coming back on market. Expireds and withdrawals are starting to pop up a little bit. We saw 103 units expire this week, 138 withdrew. Withdrawals were up by 11.3% this last week. Pending transactions this last week fell by 3%. So that means that our predictive month supply of inventory, which is basically our average daily active count, and our pending transaction count multiplied by a factor of 4.35 to get a month's worth of pending transaction count based on that week to create our month supply of inventory at 1.1 months worth of inventory, which is up from the 1.0 months worth of inventory that we saw last week. So multiple offers are becoming increasingly less likely right now as properties are spending more time on the market. Closed transactions went up by about 4.7% headed into last weekend. Again, we had Father's Day last weekend and Juneteenth last weekend. And so again, we ended up seeing that there was a little bit less market activity overall week over week, but the pending transaction count fell by about 3%. Showings were off by about 9.7% last week from the previous week before that. Now, again, headed into this next weekend, I'm hoping to see a little pop of activity before we head into Independence Day weekend. And be advised that over Independence Day weekend, we end up seeing nearly a 30 to a 40% decline in the rate of showing activity headed into Independence Day weekend. So if you're considering making a price reduction, I would make that either this weekend or wait until the weekend directly following Independence Day, because the market really starts to taper off as we get deeper into July. The odds of selling this week fell by 1.1%. We've already talked about this a little bit. It was sitting at about 58.3% overall odds of selling. The odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same week, and I project it out for a 30-day period of time. So that's the likelihood of you going under contract in the next 30-day period if you listed last week. Looking at where we were for percent of balance, we're still nowhere close to a market imbalance. To create that magical 6-month supply of inventory, we would still need to have about 27,500 active units available for sale in order to offset demand right now. And so that means that we're currently sitting about 19% of a balanced market. Average daily active count was about 5,200. Historically, in the month of June, we're closer to about 6,500 to 7,000 active listings based off of data from 2013 through 2019. And so again, I'm not hoping that there's going to be massive new gains in active inventory that's going to come to market this year because of the phenomenon called interest rate gridlock, where people refinanced into the 2 and 3% range and people don't want to move into a smaller house for more money right now. And so unfortunately, we're not likely to see these massive gains in active inventory this year. Stays
And I've
make
got a
it.
chart on the back half that shows exactly how many are locked in at each interest rate and how few have dropped off, meaning how few have sold those homes and bought new ones. It's really
Interesting.
shocking and kind of sad because you mean,
Yeah.
listen,
Yeah, I'm not expecting there to be massive gains in that this year. Looking at our showings this last week, I think that I said showings had dropped off by 9.7%. I would stand corrected. Our showings actually dropped off over Father's Day weekend in Juneteenth, which was a 3-day holiday, down by 11.6% from the previous week. So that meant that you should have gotten 2.5 showings on your listing based off of data from last week. So if you're not getting your 2.5 shows per property per week, that could indicate that you are overpriced on your listing. You may need to go through and make price adjustments. But we said about 13,000 total showings last week, which was down from the weekend before. I hope that it props back up this weekend. Before we go into Independence Day weekend, there's typically a little pop of activity that happens right before a 3-day holiday weekend. It's actually going to be a 4-day holiday weekend this year, since Independence Day falls on July 4th. Be advised, we are actually closed on July 3rd and July 4th this year for First American Title. So make sure that you're organizing your closings around those dates. Looking at shows to contracts, the good news is the buyers that were out this last weekend, they did get deals on these transactions, but the number of properties they were looking at before going under contract was about 12. So if you've had 12 total showings on your property and no offers, it may be time to consider a price reduction at that point. Again, pendings were down by about 3%. Total showings were down week over week by about 7.3%. But shows to contract, those buyers were serious if they were out over Father's Day and Juneteenth weekend. Median days on market for units that went under contract last week popped up to 9. We had bottomed out back just after Easter weekend at about 5 median days on market. Now we're looking at about 9 median days on market. So homes are spending 1 or 2 weekends on the market right now. So they're taking a little bit longer, especially in light of these holidays that are coming up. I expect average or median days on market to continue to climb as we get into the later part of the year. We've really passed the fast part of our season, and we're waiting until next year before we start to see median days on market start to drop again. The rate of price reductions increased this last weekend. We ended up seeing that 32% of what went under contract ended up making price reductions, and we ended up seeing that 66.1% made no change. Looking at price reductions, they were a little bit smaller this week at about a 4.9% price reduction, or about $37,000 off of the original price in order to go under contract. Now, for units that are up to $500,000, again, this represents about 27.1% of our overall housing inventory right now. We end up seeing that our market in the under $500,000 market also starts to transition as we get into early July with these transactions. And so we start to see these early July listings closing in August, but we start to see our active inventory really start to rise as we get into the next couple of months, and our pending transaction count starts to taper off as we get into early July. Here's our heat map by week going into this last weekend. Again, we peaked out back here right after Easter weekend in this market where we had a 77% odds of selling. Now we're down to about a 69% odds of selling. So it ended up dropping off by about 8% in this market as well. Our average daily active count in this market only rose by about 2.5%. So we're seeing fewer new listings make their way to market in this overall particular price segment. We were sitting about 7.5% fewer new listings coming to market this last weekend. We're seeing back on markets decline at 8% week over week, and that's down by 40.3% from where we were the same week 1 year ago, which is really interesting. There was a higher fallout rate last year than there was this year. Expireds and withdrawals were also down this last week, but pending transaction count for the under $500,000 segment over Father's Day and Juneteenth weekend by about 14.3%. So it really took a big hit out of this market. In this market over the weekend that was just before or right after Easter weekend, we ended up going down to a 0.4 months worth of inventory. Now we're sitting at 0.7. So multiple offers are still likely in this particular price band as we start to see more downward pressure due to higher interest rates on lower price points where people are moving down into smaller houses right now. And so we're sitting at about a 0.7 month supply of inventory right now. Looking at where we are for the odds of selling week over week, it only declined by about 0.8%. We were sitting at about a 69% overall odds of selling. We're only at 11.4% of a balanced market, whereas this market would need to have about 9,700 total available listings in order to offset demand right now. Last week, showings ended up declining in this market by about 7.1%. We had about 4,400 total showings that were set in this market. That means that you should have been getting about 4 showings per property per week in this market. So if you're not getting your 4 showings per property per week, you may need to consider a price reduction. In this market as well, we were looking at about 12 showings to go under contract. So we've had a total of 12 showings and no offers. It may be time to go through and consider a price reduction. Median days on market for this one spent a little bit longer on the market this last week due to Father's Day weekend and people taking that day off to spend that time with family. We were looking at about 8 median days on market, which is up from the 5 median days on market that we experienced for the bulk of March and April of earlier this year. Price reductions, we ended up seeing that there was an 8.3% increase in the rate of price reductions this last week at 28.9% of homes making price decreases this week. The average price reduction was about 4.9%. That ended up going up just from last week where it was a 4% price reduction the week before. We're looking at about a $21,000 price reduction right now for homes that are under $500,000 to make a difference and to get them under contract. When we start to get into the $500,000 to $1 million segment, this represents 60.2% of our overall housing inventory for active listings currently. And you can see that harsh cutoff where we end up seeing a bigger chunk that comes out into June and July as we start to get deeper into our selling months, into our summer months, where people really start to pull back and looking at their homes with a really hot time frame. It's really March, April, and early May, whereas in late May and early June, we start to see that taper off in our buyer activity. Here's our heat map based off of the week. You can see the cooling trend settle in and our active inventory starting to climb here, turning blue. Shows per property per week are also down as we get into this $500,000 to $1 million segment, but the overall odds of selling was the highest back the week before Easter weekend, where we hit about a 65% odds of selling. We're now down to a 57.7% odds of selling. So overall, we're down by 7 to 8% in this particular market. Our average daily active count actually rose by 7% this last week. And again, it's not because we're getting new listings into the market, it's because active inventory is aging in place and it's not going under contract. And so that means that of our average daily active count, we ended up seeing that there were about 3,000 total units that were available for sale. And that's only up from 1 year ago by about 3.8%. New listing inventory was down 10% week over week. Back on markets were down by 15.3% and down 26.2% from the same week 1 year ago. Withdrawn and expired listings were up surprisingly this last week, pretty substantially by 26% and by 37.3% where people are pulling their listings from the market. Pending transaction count over Father's Day weekend and Juneteenth weekend for $500,000 to $1 million was down 4.9%. We had 582 total units going under contract. That means that our month supply of inventory is sitting at 1.2 months worth of overall inventory in this particular market. The odds of selling again decreased week over week by about 2.3% with a 57.7% overall odds of selling. Our average daily active count to create a market imbalance, we need to have about 15,000 total units available for sale. So we still only have 19.5% of what would offset demand right now. We're looking at 2.3 shows per property per week in this market. We had about 6,600 total showings that were set. We saw an 8.1% decline in the number of showings that were set over this last weekend due to Father's Day and Juneteenth. Shows to contract. So the buyers that were out this last week, we're looking at between 11 to 11.5 properties before going under contract. So that means that if you had 11 or 12 showings on your property and no offers, it may be time to go through and consider a price reduction. Looking at where we were for median days on market, it went from, we were at 9 median days on market last week. Now we're up to 10 median days on market. So again, people taking off Father's Day and Juneteenth in order to be with family over this holiday weekend. We ended up seeing that the rate of of price reductions only increased by 1.1%, with about 34.3% of all the homes that went under contract last week experiencing at least one price reduction. The average price reduction was smaller this week at about a 4.6% price reduction, or about $35,500 off of that original price. Here's our $1 to $1.5 million price segment at 7.6% of the overall inventory. Hottest months. Yeah.
Question for you. The 500 to $1 million, have you talked to any of the agents about the expireds and withdrawals, like what you're seeing in that price point?
I haven't actually. And so it'd be interesting to do a poll as to those expired and withdrawn transactions to see why they chose to pull their listings from market. And so we ended up seeing that during the big rainstorms earlier in May, that a lot of people were withdrawing or expiring their listings because they had some water damage to their properties, and they had to pull them from market to do repairs and clean up their properties before relisting them for sale. And so, you know, I would be interested to see why that ended up going up so much over this last weekend, but I'm not quite sure.
Yeah, it would be very interesting. If you guys know anything, put it in the chat and we'll talk about it when we switch. Yeah,
definitely. Looking at this last week for a $1 to $1.5 million segment, we peaked out back here right after Easter weekend with a 56.7% overall odds of selling. Now we're down to about 47.2% overall odds of selling. We can see that our active inventory in this column is starting to climb in this particular market. Now in the $1 to $1.5 million market, we ended up seeing that our average daily active count went up by 5.6%. Again, it's because inventory is aging in place. It's not because we're getting propped up with new listing activity. New listing activity this last week was down by 19.7%. Back on markets fell this week by 5.9%. Expireds were down by 42.9%. So we saw fewer expired listings this last week. The withdrawn market we saw 15 units withdraw at 7.1%. Pending transactions fell by about 7% overall during Father's Day and the Juneteenth weekend. And closed transactions were down by about 24.2% this last week. So our month supply of inventory is now up to 1.8 months worth of inventory, where we bottomed out at 1.1 months worth of overall inventory back in April. The odds of selling ended up sliding this last week by 4.7%. So these folks really spent time with their family over the holiday weekend, with our odds of selling sliding down to 47.2%. In this market, we're now up to 20.3% of an overall balanced market. We would need to have about 2,700 total homes available for sale in order to offset demand. We were looking at about 1.7 shows per property per week. Overall total showings were down by 13.6% over the holiday weekend, with 943 total showings that were set at 1.7 shows per property per week. People were on average looking at about 14 showings to go under contract, which was down from this last weekend. And I've got a question for you guys. These labels are really starting to muck up my graphs, because the longer that I put together this report, I thought this was going to be like a 1-year report where I was reporting on this weekly, but now we're going on 3 years for putting together this report. And so I'm wondering if I should just pull the labels out to clean up these graphs a little bit and then have the numbers down here along the bottom. It's starting to get to be a little bit too much for me to look at. Median days on market, we're looking at about 10 pending average days on market for those units that went under contract last week. That was up from 6.5 just the week prior, 7 the week prior. We saw that price decreases were actually down this last week, and which is kind of interesting. We tend to see larger price reductions for those units that are going under contract over holiday weekends. And so the rate of price decreases was about 28.8%, which was down 4.5% from the previous week. Of the units that went under contract last week, 69.7% remained with no change whatsoever. The price reduction ended up being a little bit smaller this week, with a 6.7% price reduction, or about $90,000 off of the original price to go under contract. For homes between $1.5 to $2 million, we're looking at about 2.8% of our overall inventory. So this is a much smaller segment of our overall inventory that we're looking at. But the best time to list these properties based off of historical data is typically the month of March. Getting into early May, late May, and June, we start to see that the odds of selling and overall market activity begins to slow. Here's our market activity from this last week. Again, we peaked out back over the weekend directly before, or right after after Easter weekend at 53.2% odds of selling. Now we're down to a 37.6% overall odds of selling for homes between 1.5 to 2 million. Our active inventory is continuing to climb in this particular market, and our average daily active count is 277 total units available for sale, which was up 7.8%. And it's still not because we're seeing new listings make their way to market, because that was down by 16% over this last week. We only had 37 new listings come to market overall. We ended up seeing that our expired listings were down, withdrawn remained flat. Pending transactions, interestingly enough, actually went up this last weekend by 10%. We put 22 units under contract between 1.5 to 2 million. So our month supply of inventory remained overall flat. Last week it was 3 months worth of inventory. Now we're down to 2.9 months worth of overall inventory. And so our average daily active count in this market is up by 56.5% from where we were 1 year ago. The odds of selling ended up declining this last week by about 4% over our holiday weekend. And so we were sitting at about a 37.6% overall odds of selling. 24.1% of balance, we would need to have about 1,150 homes available for sale in order to offset demand. We were looking at about 1.4 shows per property per week for this particular listing. People were looking at more homes this last week. We were looking at about 18.2 showings to go under contract before people pulled the trigger to go under contract. So it took about 18 showings for your home to go under contract. Days on market ended up jumping pretty drastically. So we put some of that aging inventory under contract this last weekend, but we went from hovering around 8 to 17 median days on market for the last couple of weeks, up to 36.5% or 36.5 median days on market for those units that went under contract this last week. Median days on market tends to continue to grow. I think that we had a couple of units that had been on the market for a long period of time that finally reduced their price and went under contract. So that number may come down as we get into the next couple of weeks. We ended up seeing that the rate of price reductions was only up by 0.2% this last week, with 31.8% of homes making a price reduction. And we ended up seeing that, the rate of price reductions was a little bit smaller this last week, with an 8.5% price reduction, or about $177,000 off of that original price. And so that is your weekly update in a nutshell. It looks like we have a couple of questions, so I'll pop open the Q&A and look at that. So we said that several sellers around Berkeley decided to rent instead of stay on the market. And so people choosing to rent out their house instead of go through and list their home for sale. Yep, I'm going to pull out those labels, Gordon. Definitely. I think it's time to get rid of those. And so when I say the odds of selling, that's basically I take into account all of the available homes that are listed for sale that week versus those that go under contract and or close in the same week. And I project it forward for a 4-week period of time. So if we continue putting units under contract at the same rate and no new listings come on market, what's the likelihood of your listing selling in the next 30-day period? And so in regards to graphs being more legible and less cluttered, maybe give 2 perspective. 1, last 8 weeks, and 2, your all-time graph. Or send me an email about that, what you're hoping to see, and I'll take that into account when I go through and update the slides for next week. So I've got to go through and do a major overhaul and pull out all of those labels, so it's just getting too busy to try and look at all of that stuff. So I think that answers all of our questions. Nicole, you got 2 extra minutes this week. Let's turn it over to you. You're on mute.
I knew that. And I was looking at apartment list while I saw the Q&A about the Berkeley homes being rented out. We're talking to a lot of folks right now who are converting their current primary into a rental. I mean, especially, and I hate to say this because we need the inventory, but this is the opportunity. If you have a home that's locked in at a very low interest rate, and it's going to cash flow if you rent it out, that might be the home that's the perfect investment, not one that you would buy. So looking at doing that, Colorado numbers, we were actually up last month over month, 0.6% in our rents. And you got to remember, with all the new builds that are going on, they're mostly condos. So they're building up. because, you know, you just can't build land anymore and you have to go further out of the metro in order to do that. So if that's the case and you've got your hands on a townhome or single family, the opportunity to gain rent that cash flows and build wealth is certainly a conversation that should be having right now with all of your clients, because that might just keep them in the game. So I'm going to go ahead and share my screen. I'm going to put this in presentation mode. All right, give me just a second to do this. Let's do it. Share screen. All right. Oh, Mr. Brian Smith, what a joy he was. He was actually really quite fun. So get out in front first and run faster. I had a Michael Jordan quote that I was actually going to present today, and I might save it for next week. But when I heard him say that, guys, winning the game isn't necessarily any more complicated than that. How are you building your top of funnel? How are you creating content? And are you engaged? Are you staying in flow? Are you staying in front? And are you staying in relationship? Massively huge win right now. You can't control the inventory. You can't control the interest rates. You can't control the market. And when we see 60,000 agents have already left the business in the last 6 months and 31% of the lenders, you know, it's a little tough right now. It is. And it might actually get a little worse before it gets better. And I'm going to talk about what that looks like and why. But hold on, because interest rates will drop. And also buyers at some point get used to interest rates in that 6 to 7%. We're already seeing that. We're seeing mortgage purchase applications increase with a very slight drop in interest rates. That means that they're getting used to it. They know that they want to take advantage of it. And then having the conversation that when you have 64% of buyers sitting on the sidelines waiting for interest rates to drop, what's going to happen when they do? It's going to be mayhem, and it's going to put an increased pressure on prices, causing even more unaffordability. So if we can get in front of that and put that person in a position to win when prices go up and refinance when interest rates go down, the opportunity to gain wealth through real estate is right now. All right, so let's jump in. So these next couple slides, tons of words, but I actually wanted to capture the major segments when Fed Chair Powell went in with his semi-annual monetary policy report to Congress. That just happened this week. And really what he highlighted was a handful of things. He talked about the fact that he understands that high inflation is creating a hardship and that he's committed to bringing inflation back to 2%. Now, if you remember, go back a couple of years, they actually moved away from that. They said that we wanted 2%. Then we said, well, we could go slightly over 2%. And then they said, well, we just want an average of 2%. And now he's saying, nope, we want 2%. So what is it going to take to get there is what I want to show you. He also said that all of the participants, or nearly all of them, some of them were actually higher than this, said it would be appropriate to raise interest rates further by the end of the year. Almost all of them said we expect to see 2 more increases. Some even said more than 2. And remember, when we're talking 2, we're talking a 25%, so 0.25 increase each time. So 0.5 in total. What is that going to impact? It's going to impact your HELOCs. It's going to impact the cost to borrow. It's going to impact the interest rate on your credit cards. I'm going to talk about debt consolidation later as an opportunity for you to get in front of your database. It's going to continue to increase the cost of a lot of things while we're waiting for inflation to drop down. So let's hope that it actually is successful in that. But he's saying that we just need to continue to watch more information. Reducing inflation is likely to require a period of below trend growth and some softening of labor market conditions. So below trend growth, we're talking about GDP growth, and we're trying to get inflation down to 2%. So what does that mean? I've shown this chart before, but not as long. The data wasn't as compact as it is this time, because I actually wanted to show you the trend line prior to COVID. Super important that you look at this. So here's where we are right now. So we saw the drop off of this May 0.63 from May 2022. That's significant because when we saw the May of 2023, it was 0.43, and that dropped off 0.63%. And remember, the annual inflation is the sum of the monthly inflation. So we just sum all 12, and that's what gives us the year-over-year inflation. So that dropped from 5.5 to 5.3 for the core CPI. He wants to see a 2%, not an average of 2% and not slightly higher than 2%. He wants to see 2%. So what does that mean? If I take 2% and I divide it by 12, I need to see an average of 0.16% every single month. We're not there, but we were there before COVID. So we got to get back down to this range for an extended period of time before we're going to start to see the Fed dropping the Fed rate. Now, what does that mean? It could be longer than we had hoped based on the sternness by which they're showing the 2%. But here's a couple of other things. So we're going to replace this June number next, 0.6. And that's pretty big. But then July is down low. So we're not going to see the massive drop in inflation in that July data, which will actually be in the August report. The same goes for headline. Now, headline June's numbers, which is about to be replaced, it was 1.2. If I go to July, both headline and core won't see the big drops that we saw the last couple of months in headline numbers. So I'm just kind of putting that out there because we saw a massive uptick in the stock market as well. Inflation is affecting both stocks and bonds right now, as well as the cost of everything else. So again, it could get a little stagnant and even a little stay higher for longer than we were all hoping for. So the conversation has to change. It's not just about marry the house and date the rate. It's just going to be a few months. No, this could be an extended period of time. What does your financial outlook look like? How do I continue to help you move? Because you're still getting married, getting divorced, getting widowed. You're still having kids. Kids are leaving the home, getting a new job, graduating. Those life events are still happening, and we want to lean in and be in flow with those clients when that happens. So there's a 74% probability that we will see a 0.25% rate hike in July, and then a higher, and then that continues. We're probably going to see 2 increases unless the jobless numbers continues to be high. So the initial jobless claims numbers just came out this morning, and they were pretty flat. So we saw 2 weeks where it pushed out beyond the 4-week trend line, which showed that what the Fed Reserve was doing by pushing up the Fed rate was working. We were seeing more people being laid off and entering into the unemployment phase, right? So initial jobless claims, the first time you get an unemployment check and request that is when you get into initial jobless claims. This week, it was only up 2,000. So we're talking about it mostly being flat, but of course we have to go back to October 2021 to see that. And if I go pre-pandemic, it's back to 2017 to see that level of initial jobless claims. So that's good news. I hate to say that because you don't want to wish somebody to be unemployed, but certainly if we continue to see that, that might be the only reason why the Fed will just hold tight for higher for longer and not raise the Fed rate. The other side of what's affecting interest rates not only is inflation and the Fed rate and Fed action on trying to cause a pause in the market so that we control inflation. Remember, the Fed rate does not actually impact the 30-year fixed. The Fed rate is trying to create a pause on demand, which allows supply to catch up, which drops inflation. Dropping inflation drops the 30-year fixed mortgage rate. The other thing is the instability of the financial market. So a report also is just continuing to be a conversation around the commercial real estate space. And in fact, Citigroup came out with a study showing that banks overall represent 54% of all commercial real estate loans, and small banks are 70% of that. In fact, small banks hold 4.4 times that of their larger counterparts. Why does that matter? Because it's the small banks that are at risk of defaulting, not the larger banks, not the Citigroups, not the Wells Fargos, not the US banks. It's the small regional banks and local banks that gave those commercial real estate loans, and those are the banks that are at risk of defaulting if too many real estate portfolios or products default. That is going to create additional illiquidity and additional stress on our financial markets, which is creating a broader bandwidth between the 10-year treasury and the 30-year fixed. Right now, we're sitting at 3.2% spread. Remember, the average is 1.65%. So I'm looking at this going, okay, right now, our 10-year treasury is like at 3.7, yet our 30-year fix is at 6.9. If it was really 1.65% higher than that, we would already be in the fives. We would be at 5.2, 5.25, certainly not 6.9. We just need the financial markets to reduce the level of risk in order to drop that almost immediately. It doesn't even matter what inflation is doing. So we have these two buckets that are causing interest rates to be high right now, both inflation and the financial markets. So interest rates are high. You have to go back to 2010 to see this. I actually put this chart together showing conventional, FHA, and jumbo. And interestingly enough, so jumbo's the orange line, and as a whole, jumbo ranges higher than both conventional and FHA loans nationwide. Right now, they are literally all on top of each other. Jumbo, conventional, and FHA, and typically FHA is going to be your best interest rate. So they're all tight, and even depending on the market, depending on the day, jumbo might even be a better interest rate than conventional. But we're sitting at an interest rate where we have to go back to 2010. So of course, this is affecting affordability. When those interest rates drop, we are going to see some benefit to that, and we're going to see a lot more demand. But we're seeing demand even continue to come up. In fact, mortgage purchase applications were up 2%, and interest rates really didn't move this last week. And remember, the week before this, they were up even higher. So we had seen that jump the previous week, which is significant. This week, just a little bit. But long term, we have to go back a number of years in order to see that kind of mortgage demand being that low. We know that. Yet the mortgage demand is matching the inventory. I mean, we see that in Megan's numbers every week when we see that the months of inventory and the demand for those homes is continuing to keep those prices high. So where are we at with mortgage interest rates? So 91.8% of all mortgages are locked in under 6%. Remember, almost 40% of all homes don't even have a mortgage, so they have a 0% interest rate. So 91.8%, this is down from 92.9. That is a very small drop. So the all-time high was 92.9. Now we're sitting at 91.8, which means there's not a lot of mortgages respectively happening between that 6 and 7% rate right now. So as you go down, I mean, we have almost 23.5% locked in under 3, 62% locked in under 4, 82% locked in under 5, and 92% locked in under 6. Those people are creating safety in a period of time where there's more fear and instability. So yes, they're locked into low interest rates, but they're also locked into that stability of knowing exactly what that mortgage payment is. It's going to be really hard to shake them out of that, especially these 23.5%. So the conversation has to turn to, and again, I hate to say this because of course it continues to constrain inventory, but what is the long-term goal for your finances as a household, and how do we incorporate real estate into that? Have you thought about becoming an investor? Have you thought about converting that home into a rental and moving into the next one? I sat down with a client yesterday who has 10 single family homes, and he's Airbnb-ing all of them, and he's crushing it. And then other clients who are doing midterm rentals, other clients who are renting out the basement separate from the upstairs or looking at the ADU. How do we get creative and create either multiple streams of income or increased streams of income on that same property? These are the conversations that you should be having with these 62% of people that are locked in under 4%, because if they're not going to shake free, they could shake free if they kept that home and turned it into a cash flowing rental property. 245,000 homes are still in forbearance. I actually found that number pretty high, considering forbearance has been relatively over. Yet, when you think of the millions of homes across the United States, 245,000 isn't very much, and only 3.88% of all homes nationwide are delinquent, and less than 2% here in Colorado. Continued strength, continued locked in low monthly payments. We're not going to shake those homes, and they're certainly not going to go into any kind of short sale or foreclosure. Let's talk about new builds for a second, because the NAHB builders confidence just came out this week, along with starts and under construction. So single family housing starts increased by 18.5% month over month. Love that. This red line is a single family. And then of course we have the 2+ or the multi-units down below it. So to see that kind of jump, that's massive. Absolutely want to see that. Yet they're not quite satisfying the need yet. And you got to remember, I was watching an interview with the CEO of KB Homes this morning on CNBC, and he was talking about the fact of having to balance bringing too much inventory to market and creating too much inventory, if you will, in that market, dropping their competitive edge. So they're going to start and they're going to bring out this inventory, but they're going to bring it out in a controlled fashion so that they're controlling the ability to increase prices. So they need to control their market share, and they're very good at it. Builders are incredible businessmen when it comes to dripping out that inventory. So 1 units are up 18.5%, but under construction, they're still down. So the permits are up. We're getting excited. We're actually getting out there with activity, but yet not yet going. So these guys are still under construction. It's actually down. It peaked a year ago. So single family homes, we still need to see more of those. We're seeing a lot more of the builds of multi-unit homes out in the market right now. NAHB builder confidence came out and it jumped to 55. So anything over 50 is solid. So that actually means that we're in an expansionary. They're extremely positive. Certainly it's not as high as it had been, but it's creeping up and it's been going up over the last 6 weeks. So this is a good sign. Builders are taking advantage of that. This marks the 6th straight week that builder confidence has increased. And the first time it's over 50% in the last year. But low US housing inventory is the opportunity for home builders to gain market share. Yet there's still less than 25%. We hold the keys with existing inventory, existing home inventory, to provide access, especially for first-time home buyers. New home builders are not going to create the gate to all of the inventory that we need that satisfies demand, which is going to continue to have pressure on home prices. Anybody that is talking about any kind of crash or decline in home prices, we've passed that. Now we'll see seasonal slowdowns, and Megan does an incredible job of showing that going into the fall, where we're going to see seasonal drops in prices, but we're not going to see substantial drop in prices based on the fact that we just don't have enough inventory and we have enough demand that's going to propagate that. So every deal matters. Right now, existing home sales are down across the board. Here and nationwide, our numbers are off. Every deal matters. So I want to talk about a concept called recasting, which is massive. I've had this, in fact, it won us 2 deals last weekend. And I was so surprised, like I didn't know how many people didn't know about it or how many lenders didn't have it. So the big conversation right now isn't specifically about recasting. It's about, how do I buy before I sell? I mean, we've seen how low of inventory we have. How do I let go of the home that I'm in, the roof over my head? If I do want to move and I'm willing to take the higher interest rate, how do I buy before I sell? Whether I have enough equity to pay cash or whether I need a new loan, I want to do that, especially if you're talking to older Americans who are looking for that more age-appropriate home. Certainly a conversation I'm having a lot right now. So I want to talk about a couple of the options to buy before you sell, because everybody jumps into bridge loans. That's like the #1 conversation I have. Do you guys have bridge loans? Yes. But can I talk to you about like 3 other options that are cheaper than a bridge loan before you jump to the most expensive option? So let's talk about recasting really quickly. So if you have a home that you want to sell and you want to buy a new home and you qualify, because you need to qualify for both homes, and you have as little as 5% down, whether you do it as a 401k distribution, whether you have that money in savings, or whether you get it as a gift. If you can put 5% down on the new home and your income qualifies you with both homes, you can purchase that home immediately. We can close you in 2 weeks. Purchase that home, the new home, with 5% down. You're going to have mortgage insurance. And then immediately, as soon as you close on the home sale of the existing home that you owned, then all you have to do is make 1 mortgage payment, and then you can recast. You can drop mortgage insurance and you can drop that principal balance, which is going to drop your monthly payment after only 1 mortgage payment. Now, some lenders don't offer it. And some lenders make you wait 6 to 12 months. And I think that's probably why we're not having more conversations around this. But with Movement Mortgage, we only have you wait 1 month. So it's certainly a conversation. I'd rather steer you that way if you qualify, instead of talking about a bridge loan, which I'm going to talk about because we have that too. It's just more expensive. But if you put 5% down on a purchase, you won't pay any points. And then you'll drop the mortgage insurance and drop the payment. As soon as interest rates drop, then we'll do the free refinance and get you into the lower interest rate. It's all about options. The other option is having a home equity line of credit on that home that you're wanting to sell. People go to bridge loan first, but if that home isn't on the market yet, and you're willing to wait to put it on the market until after we purchase the new home, then we need to go for a home equity line of credit, not a bridge loan, right? A bridge loan is only if a house has been listed on the market. If it is not listed on the market, do a home equity line of credit. They cost little to no money. And then you can close it, right? Well, you'll close it when you sell the home. That closing, they typically have an early termination fee of about $350. So you get a HELOC, you pull all the money out of it that you want to put down on the new home, and then you purchase the new home again, you're gonna have to qualify for both. Then of course, there's a bridge loan. It's gonna cost you a couple points, 1 to 3 points, depending on which avenue we go. And it's gonna limit you to 60 to 80% loan to value. But we can do a bridge loan if you already have that home listed, and then you could buy the new home. And then of course, there's also opportunities to work with third parties like Zoom Casa, who will purchase that home for you, remove it from the debt to income ratio, and allow you to purchase the new one. All options that we need to talk about. And here's another option. What if you don't qualify for both homes? Because I get that a lot. I don't know that I'll qualify for both homes. Then what if you considered renting out that existing home and not selling it right away? Maybe you sell it in 6 to 12 months. Maybe you test out being a landlord and you decide if you like it. And if you put a lease on that home that you're leaving, I can use 75% of that lease to offset the mortgage payment, which will help you qualify for the new home while being able to pretty much dismiss the mortgage payment on the first. Guys, we need to be having these conversations, not allowing people to feel trapped in their current situation, especially our older homeowners who are in a home that is not age appropriate. How do we get them into that next home where maybe they want to pay it off fully or do a reverse mortgage and have no monthly payment for the rest of their lives and get them to move? This is a massive conversation that you should be able to go to market with and talk to. Have you thought about this as an option? Because we do the servicing in-house, that's why that will never change. We had a lot of questions online talking about, well, when the loan gets sold, couldn't those terms change? And that doesn't happen because we service all of our own loans, but that is a question, and it was a good question, that you're gonna wanna ask the lender that you're working with, who do you sell to, and what is their recast terms, so that you know before you put somebody in, if they have to wait 6 to 12 months before they can execute that recast. And then lastly, you guys have already almost tapped us out. We're almost sold out for next week's Agent Ignite and Market Update. Megan and I in person only, not on Zoom and not on Facebook. So don't look for us online at 10 a.m. Instead, we're going to be hanging out and talking about how do you sharpen your saw, what's going on in the market, what's the strategy that you need to be talking to your buyers and sellers about, how do you increase your top of funnel, and how do you bring more clients in the door? Those conversations are the conversations you should be having right now. Guys, we have the wind at our face. It's created an intense market, one where there are lots of challenges. How are you addressing that? Are you going after it? Are you jumping all into the wind, knowing that when the wind turns and it's at your back, you're taking full advantage of the increased market share you were able to gain by the activities you did during this time? That's what it's all about. How are you staying active in this market in order to put yourself in a position to win when the market turns, and even really now, because I want to win today, because I like to win. I don't know about you, Megan. I like to win.
Winning is fun.
Winning is so fun. I want to win all the time. So, oh my gosh, here we are. We got 7 minutes left. We got a couple of Q&A questions. I think I talked a little fast this week.
I know. I feel like
weird,
we're kind of rambling through it today. It's always a little bit funny when we're not together. It's like the synergy is just a little bit off. I much prefer to be together.
Agreed. And next week we're gonna not only be together, we're gonna be in person.
In person, show up, guys.
Guys, and we're close, so make sure you get in and then don't bail. If you RSVP and then you don't show up, you're gonna be on our blacklist. Like, it's just not. It's just not
I
cool.
won't send you market data anymore.
Yes,
There are repercussions.
you're gonna be held back. You're gonna be in timeout. All right, our lenders getting assumable departments up and running. Assumable, you know, they're not. They're so hard. Assumable loans are done by servicers. So unless you have a loan that's backed by like a Wells Fargo, Bank of America, maybe those assumables might be a little bit easier because you got a banker. Most of them, I'd say the majority of them, are held by third-party servicers, and trying to get those guys to organize an assumable loan, it's just going to be tough. I have not heard of very many wins at all. And remember, yes, we've seen a dip in home values, but before that, we saw a massive uptick in home values. So it's really those homes that were purchased in 2022 that you might actually, the beginning of 2022, that you might be able to assume. Otherwise, the equity difference between what they would sell it for and what the loan is at is so great that it'd be hard to assume for most people. All right, Nicole, what would you do if somebody wants to rent out their home, but now with the new Denver changes, they need a landlord license in order to rent out their home? Does that affect them, and how? Guys, it's so easy to get a landlord's license. You need to obviously do an inspection. You need to file the paperwork. But honestly, this is something that it's not a deal breaker. And if not here, then if you're looking at other opportunities, remember, we have access to all 50 states. I'm licensed in 36 and we have access to lending in all 50. But if you have a home here that you're wanting to convert, I don't think that that should be the reason why you don't do it.
Mm-hmm. So great info, ladies. Do you post this webinar for replay anywhere? Can I get a copy so that I can listen to it again? So now that you've registered for one webinar, you are forever on our mailing list. So thank you so much for that. You will hear from us until one of us dies. And so we will get you guys a copy of the recording out as soon as I send this out. And so it'll be under the title of Greater Metro Denver Market Review. And so I will send a copy of the reports and the recording out to you as soon as we're wrapped up here, along with a registration link for next week's in-person event. So please make sure that you show up for next week, as we will not be recording next week. I will still send out the reports, but it won't be recorded. So you have to be in person next week.
Well, this was lovely. Of course, the weather is fantastic. Both of us have our windows open. We weren't together, but we will be together next week. You guys have an amazing rest of your week and weekend. It's beautiful out there. Know that we're working, we're supporting you. Hopefully this is the weekend that you're going to get those buyers under contract, as summer has officially begun, but we're hoping that we're seeing lots of activity coming forward. Awesome. So other than that, Megan and I would love to see you guys at the closing table and our strategy sessions. Make an appointment, let's sit down, let's get strategic. These next 6 months, we have the benefit of working on our business when we're not bogged down by working in it. Well, we look forward to seeing you guys next week.
Thanks, guys. We'll see you soon.